All right. Hello, everyone. Welcome everyone to the RetireReady podcast. Great to be back. I'm David Nicholas here with Aaron Jones, CPA and financial planner. Glad for you here again, Aaron.
Yeah, happy to be here, David.
Absolutely. I'm just impressed. I can't even keep up. What number podcast are we on now?
This is number 5, I think.
Is this number 5?
I think it's number 5.
Production team, they're nodding their heads that this is number 5.
Good,
okay.
Good. All right.
If you would have told me we would have gotten past 3, I would have said probably not. So this is a big accomplishment.
I'm impressed. I gotta say, I'm impressed.
And our goal is to get these out every couple of weeks. So you can't really stop now. That's the problem. Once you start going down this dark hole of podcast world, you got to keep going.
Well, I think the nice thing is we got a lot of options to be able to talk about.
That's right.
We can keep the ball rolling.
That's right. Yeah. Well, today's an important topic. I wanted to spend some time talking about long-term care insurance, healthcare expenses in retirement. It's a topic that I think we know a lot about. And if you ask a retiree, hey, what do you think your biggest expense is? Sometimes you hear the word healthcare, but sometimes it can be down the list on what are some of the most expensive or the highest costs that you may have to cover while you're in retirement. And so I just want to talk about what is the state of the healthcare market today? What about the long-term care market? What are some of the ways that you can cover the cost? There's really 3 ways that you can pay for long-term care. We're going to talk about all 3 of those. I'll just give you the preview of those. The first one is just through traditional long-term care insurance. The second way is through what we call hybrid policies that are unique that we're going to talk a little bit about as well. And lastly, it's just self-insurance, meaning you are going to cover the cost of long-term care. So we're going to cover those 3 areas as well. Talk about some of the tax issues surrounding some of this. So I think it's an important topic and one that I think is really, as a firm, we're starting to really spend more time on as well.
Yeah, Dave, you sent me over an article earlier today, and I know this is some of the stuff that we've been talking about really for the last year or two. Just with the rising costs of healthcare, long-term care particularly, whether you need nursing home care, in-home care, whatever it may be. So can you summarize that article a little bit for me? I know we kind of talked about some of those details. But
I'll bring up Genworth because really what we see today, if you just look at the average cost of a private room, which is, I would say, the best you can get if you're in a nursing home facility, private room by yourself, it's about $103,000 a year for a private room. If you look at just a at-home care, and that's another option that a lot of Americans are choosing if they can, is just having someone come to your home. But still, you're talking somewhere around $54,000 a year annually. And this is according to Genworth's cost of care survey. So if you want to stay at home, $55,000 a year on the low end, or it could get 6 figures up to $105,000 for a private room in a nursing home.
It's pretty painful.
Pretty painful. Yeah.
Yeah.
And so this is one of those things where when we think about retirement, when we're building out a plan, and Aaron, you do this a lot with clients as well, when you have to build in $100,000 a year potential expense that you weren't anticipating, this is why planning and at least putting that in, I can tell you, no one wants to go to a nursing home, especially assisted living or skilled nursing. But it's the reality that at some point in our lives, many of us may face the reality that we have to go to a nursing home. Our loved ones may be faced with that case. You may have had a family member that's been in a nursing home. But I think it's the planning around long-term care that I think is the major challenge.
Yeah, for sure.
It's the unknown part of it.
Especially in the future dollars.
Yes.
Right?
Yeah.
Because like David talked about, $103,000, if you wanted a private home, best care you could get, right? But that's today. Right. So for all of our listeners, maybe, 60, 65, they're kind of thinking maybe 10, 20 years out. That's where some of these costs can get pretty drastic.
It's a good point you bring up.
Yeah. So David referenced Genworth earlier. Genworth actually has just an online calculator, easy to use for everybody. You
really
can kind
good.
of project out what those costs may be. So just assuming a 3% inflation rate, right? Obviously, inflation's been a hot topic here recently. It's been much higher than 3, but I think we can safely assume a 3% inflation rate on healthcare costs. I'm looking at in 20 years, so let's say 2041, right? That same private room, that was about $103,000 a day. I'm going to break out a calculator real quick. Could be about $15,000 a month, right?
And you know what I just noticed with this cost of care, Aaron, this is based on 2020 costs.
Yeah.
So put in 22 years to your calculator.
Yep.
Because that'll get us to 2043 actually. I just noticed
2043, excuse me, $16,500. I mean, we could be talking, instead of $103,000 a day, we could double that same amount in 20 years.
So what is that, $200,000?
Almost $200,000 in long-term care expenses. That's annual.
Right. That's right. So so someone that's 65 years old today, right? It's $100,000 today if you have a family member or a loved one that needs long-term care. But if you're 65, 85 is really our mid 80s is when we generally, not including Alzheimer's or any kind of skilled memory care, but it's usually mid 80s is when we start to see the need for long-term care. So $100,000 today, fast forward 20 years from now, you're close to $200,000 a year for long-term care.
Ouch.
Do you know what the average stay is for an American in a long-term care
I think
facility?
it's typically been about 3 or 4 years.
Yeah, it's about 3.5 years.
Yeah.
So if you take $100,000 a year for 3.5 years, you're talking $400,000, and I would say that that's probably on the lower end of what someone may need. And so, but what if it's not 85? What if you fast forward a few more years? What if it doesn't happen until 90? Now you're looking at close to $19,000 per month for care. Wait, I did my math wrong on that. I said $100,000 a year today.
Yeah, 200.
200,000 a year.
Double it. Double it.
It's like my brain can't even process that. No, not 400,000 a year. If it's $200,000 a year for 4 years in a long-term care facility, $800,000 could be your total cost of care.
When you talk about spending 7 figures on just long-term care expenses, that gets pretty painful.
So husband and wife, let's say God forbid, husband and wife, you both need long-term care. I mean, you could potentially be looking at close to $1 million for each, so up to $2 million, or on the low end, call it $1.6 million for 4 years of care. And this is using a 3% inflation rate. But if you actually look, I just was looking this up. Do you know what the average rate of health care cost inflation has been over the last 20 years?
I think it's been pretty high.
It's 5%. I'm actually scared to do this. Let me bump this up to 5%.
Go ahead.
Oh, so this is where it just gets. It's painful. If long-term care and healthcare costs just appreciate to the same degree like they did the last 20 years, and that was also at a time when inflation was at rock bottom.
Yeah.
So you had a low inflation, but yet healthcare increased at 5% per year. Healthcare inflation. Imagine a world where we have reasonably sticky inflation. What do we think healthcare costs are going to do? Did you run that number?
Go ahead, tell me.
Okay. So 5% inflation rate for healthcare, and in 2043, so 20 years from now, $25,000 per month for long-term care, $300,000 a year. Now that is a private room. What if you wanted to stay at home? I think we've got our numbers here for in-home care.
About $13,300.
About $13,000 a month. Okay, so again, that's a big difference.
It's a big chunk.
Big difference between being in a facility and staying at home. $13,000. What are we looking at? $160,000 a year.
$160,000.
I never thought I'd say $160,000 is a bargain, but relative to having a private room in a nursing home facility, I think if we all had our choice, we'd rather be at home
for sure
if we could. And so that is just, those numbers are really, they are absolutely mind blowing.
They are.
They really are.
Yeah. The encouraging thing is, like you mentioned earlier, you've got a few options, right? I think we talked about a few. Some people continue to be self-insured, right, through real estate. Most of the time, you can't stay in your home, right, and provide that long-term care if you needed a facility.
Yep.
Right. So if you have your home paid off, great. There's an area of equity you can kind of tap into to cover some of those costs.
So let's talk about those 3 areas, right? So we know the costs are obviously increasing. They're only going to get more from here. Now, Americans are living longer. That's one positive. I think Americans are getting healthier. We probably will be blown away with the health advancements that we'll see over the next 20 years. But if our assumptions are just knowing what we know now about technology, healthcare, aging, obviously the costs are going to continue to grow, I think, well beyond what even many of us realize. But how do we cover it? And so there's 3 primary ways that you cover long-term care. The first one is just traditional long-term care insurance. So we all are familiar with this kind of insurance. It's almost like having car insurance. With car insurance, you pay your monthly premiums. And guess what? As long as you own a car, you're going to pay those monthly premiums. Every month you pay your premium, The goal, though, no one wants to get in a car wreck or have damage to their vehicle. But if you do, what do you have? You have the insurance. But if you go for 20 years and you never have any type of accident or speeding ticket, does the insurance company give you back all your premiums that you paid?
Not at all.
For your no,
Not at all.
no. Because why? Because that was the coverage for the insurance while you had the policy.
Right.
So, what would you say? What's the benefit for traditional type of long-term care? Well,
It's a peace of mind primarily.
okay.
Right. It's usually generally cheaper. Right.
That's
a
the big
one.
benefit,
And then you've
yeah.
got peace of mind knowing that you're covered
Yeah.
if in case you needed it.
Yeah, because monthly premiums, when we run some illustrations for clients, a 65-year-old, you may pay $250 a month for traditional long-term care. So you and a spouse, maybe $500 a month or $6,000 a year in long-term care premiums. On the surface, might say, hey, you know what, that's pretty affordable. I think I could do that. But are those long-term care premiums that you pay generally fixed, or can they change?
No, that's the challenge.
Yeah.
They're not fixed.
Yeah.
Right. So
Yeah.
every year as you get older, they're going to bump up those premiums. Right. God forbid you had some type of health issue, and then those premiums are really going to start jumping.
Yep, yep. And that's the key, because I've seen so many individuals, they take out a long-term care policy today.
Mm-hmm.
They may pay on this policy, or they took it out 10 years ago. They've been paying faithfully on this policy for 10 years.
Mm-hmm.
Every quarter, every month, whenever their premiums are due, they pay their premium payments without fail,
Yeah.
only to realize 10 years later, the insurance companies have just raised their premiums by 30%, by 40%. We've seen some increases that are just unsustainable. The challenge is, and it's not that these insurance companies are evil and they are trying to make it so you can't afford their insurance. It's just the cost of long-term care insurance has risen at a much faster pace than the insurance company actuaries actually priced into the premiums. So what happens was they priced these policies too low. And now years down the road, when these policyholders are going on claim, they realize, wait a second, it's costing us, $100,000 a year for a nursing home facility. You may only have $30,000 in that policy in premiums. There's no way financially that works. And so this is why my caution with just traditional long-term care insurance is you may feel good about the premiums that you're paying today, but that may very well be a very different story 5 years from now, 10 years from now, or 20 years from now, unfortunately. Yeah. So, Aaron, I know you've got clients that we've looked at long-term care insurance for, because there's this next, so that's the traditional care.
Yeah.
I call it use it or lose it.
Mm-hmm.
You pay in premiums for all these years. Hopefully you don't have to go into a nursing home facility, but you've now spent all that money on long-term care insurance. So that's what we call our use it or lose it. It's traditional long-term care. The second is what we call a hybrid policy. This one is actually pretty unique, and we've done this for clients. Again, historically, I haven't been a big fan of long-term care insurance, but the one I do like are these hybrid policies, and there's a few reasons for it. Aaron, do you want to just kind of give us the high level of how these hybrid insurance policies works, and how are they different from just your traditional long-term care policy?
Yeah. So as David mentioned, you have the one, use it or lose it. You pay all the premiums. If you didn't need the insurance, well, then bummer, all those premiums have essentially gone to waste, right? With the hybrid policy, the crazy thing with this policy is all the premiums you pay in, you pay a set amount of premiums, right, over a set determined number of years, right? And then let's say over the next 10, 20 years, pass away, you never needed the care. Well, great. Now your beneficiaries in that policy actually receive your premiums back.
Okay. So give me an example when you say over a number of years. What do you mean by that?
Yeah, so I know we kind of talked about a few. One kind of structure that we really like is like a 10K, 10 pay type of policy.
Okay.
Right. So that means you pay $10,000 annually, right, over a 10-year period, and then you're done, right? After all that, you're done. So you know, hey, factoring in $100,000 over the next 10 years, and then based on your age, based on health, it gives you a certain benefit that you can use for long-term care. Right. And then, okay, hey, maybe at the end of the day, you haven't ever needed the care. Well, awesome. Now you know your beneficiaries on that policy, you actually receive that $100,000 in premiums back to them.
Got it. Okay. So let's just use an example, because you sent me a policy that you recently did for a client. So here's a client, male, age 60, non-tobacco. That's good.
Important.
Couples discount.
There we go.
So you get a discount for being married.
You do.
Finally, some pro being married discounts. There you go. That's good. So we have a non-smoker who's married, 60 years old. So what this is it's $10,000 a year in premium, which again, it's a lot of money. I mean, it's still $10,000 a year.
It is.
But it's a 10 pay, meaning you pay $10,000 a year for 10 years and then you're done with premiums.
Yep.
No more premiums. So unlike the traditional long-term care policies where you pay every year for as long as you live until you need the care, this one is only 10 years and you're done. So he's 60. By age 70, his long-term care policy is completely paid up.
Completely covered.
Okay. Can the insurance company change his premiums that he's paying each year during that 10-year term?
They can't because he's locking into that contract year one.
Year one. So $10,000 a year, that's it. No, he knows what he's getting, no more, no less. $10,000 a year for 10 years.
Yep.
Okay. And I like that aspect of it because as planners, we can plan for that. We can say, hey, here's a budget of $10,000 a year out of your financial plan.
Yep.
We can show this for the next 10 years and we can clearly see it coming out of the plan, which is good. Okay. What is the duration, what we say that the long-term care benefit period?
There's a few different ways you can structure it, but generally it's going to be a 4 or 6 year period. As we talked about earlier, the average stay is about 3.5 years.
Yep.
So usually for us, I think we lean closer to that 4-year period. Bigger benefit for you.
So when you look at the statistics of it, there's no point insuring for more than 4 years. I mean, we can, but the probability wise,
Statistically.
you're getting your best value.
Correct.
At a 4-year kind of
Yep.
coverage period, meaning
Yeah.
it'll pay your long-term care expenses for up to 4 years.
That's right.
In the policy. Okay. All right. So let's take a look at it. So he's 60. Let's just take a look at age 85. I don't know if you've got this same illustration.
Yeah, we got to pull it up here too.
Okay. So let's just say age 60, he starts the policy, pays in premiums for 10 years, $10,000 a year for over 10 years. So he only has $100,000 into the policy. Age 85, God forbid he has to go into a long-term care facility. What will the policy pay him out?
So on an annual basis, it'll pay him at $116,000.
$116,000 a year, which is basically what he put it in premiums.
Exactly.
He gets it all back in the first year.
Correct.
Essentially, and a little bit more. But that'll pay up to 4 years.
Yep.
So total bet, if he's in a long-term care facility for 4 years, his policy will pay out $481,000
Yep.
over that 4-year period.
Exactly.
And that's actually interesting because if you think about it, well, what's the rate of return on that? Well, that's about a 7% annualized rate of return. In order for it to turn $100,000 into $481,000 over that time period, you'd need to earn about 7%. And so that's not a bad return on an investment. If I put $100,000 away over 10 years, I get out almost $500,000 on the policy. That's a pretty good ROI. Okay. Well, what did we say if he needs at-home care? What was our at-home care cost for? Let's look at 25 years from
We
now.
can keep it comparable with 25 years. Yeah, like that.
Yeah. So at-home care costs 25 years from now.
So in 2048, an at-home care cost. Let's see, home health aid, about 17 grand every month.
That is unbelievable.
Every month.
So if we do some math on this, 17,000 a month times 12. So that's still $200,000 a year
204,000
to cover long-term care.
Yep.
So obviously this policy was not going to fully cover that.
Right.
It'll cover about half of that,
Yep.
a little less than half. So let's do what would this policy pay? And so if I take 204,000 and if I take out, what do we say, 116,000,
Need about 84.
there's about $88,000 less left is the difference to cover long-term care. But here's the other thing we have to think about. He's still getting Social Security. Social Security will continue to pay for as long as he lives. I'm curious to think, what do we think his Social Security will be 25 years from now? I'm guessing if we do some round numbers, if he's getting, say, $3,000 a month in Social Security today, let's just say it's probably a little bit more than that. And if we grow it at a 2.5% inflation rate, to be fair,
Yeah, it's fair. I think that's been the
and we
average.
said for 25 years,
Mhm.
his Social Security is $5,500 a month times 12. So his Social Security is about $67,000 a year.
And there we go. We're almost
So basically, when you add in his Social Security of $66,000 a year, plus what he's getting from his long-term care policy of $103,000, let me do my math there. He's now at about $170,000 in total income that he has coming in.
That's right.
What was his cost of care? We said
About 204.
about $200,000. So he's almost fully covered his long-term care benefit. And so he still has retirement accounts. So it may mean that he has to subsidize part of his payment from his retirement accounts. But again, if the one thing about this is generally when you're in a long-term care facility, that's your food, that's your what you need to live, your utilities. There's not a whole lot of extra cost. So his cost of living may actually be substantially lower because it's just what he's paying for the long-term care.
Yeah.
And so that's where you can structure it if from a planning standpoint. If you want to fully cover your long-term care expenses, well, maybe you put $15,000 a year premiums into the policy or $12,000 a year premiums to be able to make sure you're fully structuring the policy. But I think that's pretty interesting. Now, if let's just say best case scenario, he pays in premiums for all these years and then he actually never needs care. So he passes away at age 90, what would happen in that? So he puts in $100,000 to the policy, passes away at age 90, never goes into a long-term care facility. What happens then?
His beneficiaries get his premiums all back, right? Plus a hair bit of interest, but essentially just his premiums back.
So the $100,000 that he put into the policy, he doesn't use it. That goes back to his beneficiaries as a death benefit.
As a death benefit. That's
beneficiaries pay taxes on the death benefit?
Not at all. Yep. Income tax free.
Awesome. Okay. So I would say on the traditional long-term care where you just pay premiums for as long as you live, the pros are you might get a cheaper upfront cost.
It's cheap in the short term. Is what
cheap
I'd
in
say.
the short term. For one person, it may only cost you $3,000 a year compared to $10,000 a year for a hybrid policy.
Right.
But even if you start at $3,000, those premiums can go up. So that's the pros. You start out more affordable. The cons of the traditional policy are if you never use your long-term care, you've lost all those premiums. So let's talk about the hybrid policy. Pros of the hybrid policy would be
it's a known amount of premiums and time period
that
you're having to pay into. So there's a set amount that over a period of time you're going to have to pay.
So my long-term care is costing me $100,000.
Exactly.
Over 10 years.
Yep.
That's it. It's fixed. There's no more.
Correct.
Okay.
And then if I don't need the cost of care, well then great. I know what I paid in, my beneficiaries are going to get as a death benefit, income tax free.
So my beneficiaries get back what I paid. So it doesn't necessarily cost me from a premium standpoint if I don't use the care. Okay. So those are the pros. What would you say the cons are?
Cons are it's more expensive.
Yeah.
Right. And depending on how much care you actually need, you may need to subsidize with either Social Security or still a little bit of retirement accounts.
Yeah. No, that's good. And I think it's something we talked about too. The other cost could be the opportunity cost of that $100,000 in the premium or in your policy versus it being in the market. Yeah. So we could make that wager if you never needed care. Well, that $100,000 could have been in the market earning 4, 5, 6, 7%, whatever that number may be. But at the end of the day, we're insuring a risk. And I would say there's no free lunch, right? Either you can't have your cake, eat it too. You can't have insurance and a great return. But I will say, if you ever actually need care, it is a great return on your $100,000 on the money that you put in. Because when we look at these rates, I mean, they're pretty impressive. And the earlier you turn it on, even more impressive it is. But even that, if you waited till long-term care all the way into your 90s, you're still sitting at a 6% annualized rate of return. On the premiums that you paid, you'll get that back in care over your lifetime. So, okay. So you've got traditional long-term care policy, use it or lose it. You've got the hybrid policy that we just discussed. Last way is what I like to call you're just self-insured. So you may be someone that says, hey, look, I've got concerns about long-term care, but maybe you've saved $4 million for retirement. Maybe you've got a primary residence that's completely paid for. Maybe you've got a secondary home that's paid for. And you may say, David, I've got enough assets. Do I still need a long-term care policy? So I'll put you on the spot with that question. So someone that has $4 million in a retirement account, home's paid off, maybe a second home, do they still need a long-term care policy, or would they be considered self-insured?
Under that type of scenario, we would consider that person self-insured. Right. So where insurance would come in would be if they have worries that are keeping them up at night and they say, hey, I really want to protect my estate from those potential costs, right? Well, they're great. Hey, now you know you've got the assets to cover that today, but also you're only doing that because you want that peace of mind for insurance.
So, right. So more about estate planning then. So if you're someone that's got, if you think you're well off or you would be considered self-insured, we're going to tell you how the best way to cover care as self-insured. But if you're someone that's self-insured, you think you're well off, I would put you into two camps. One, you don't need insurance because you're self-insured. We'll show you how to cover that here in a second. Or two, you say, well, yeah, I have enough to cover long-term care insurance. We've done well. We're going to be okay. But I don't want to deplete my estate in the future to cover for care. I don't want me and my wife to spend down $1 million of which would otherwise go to our kids and our grandkids. So I'd like the peace of mind of having a policy. I'll take a little bit of my account today to insure against that risk. And it's really more for your estate planning needs of not wanting to deplete your estate just to cover long-term care expenses. Is that generally what you see?
That's fair.
Planning? Yeah. Okay, well, how do we cover care? So generally, I would say if you're someone that's self-insured or you're going into retirement and you don't have a long-term care policy, here's one of the big requirements that you have to make sure that you have. And I am a big believer of having your primary residence paid for, because this is really so important. If you can get your primary residence paid off, I would say before you're retired or within 5 years of retirement, your primary real estate is really one of your best places to cover long-term care needs down the road. So let's just use an example. Let's just say that you've got a primary residence that's worth $500,000 today, and it's completely paid for. If you just look at let's just take a 3% rate of inflation, that property will double in value over 20 years at 3%. So a $500,000 piece of real estate today will be worth $1 million 20 years from now.
Similar with those healthcare costs we were running earlier.
That's right. Well, a little less than that, but you're right. I mean, it's even just at the standard base rate of inflation at 3%, right? So at $1 million at age 85, if you need care, what can you tap? Well, you can tap the equity in your home, because you can't live in your house and be in a nursing home at the same time. Well, what if you want at-home care? Well, and you love your house. David, I'm never moving. They're going to have to drag me out of this house. You can do a reverse mortgage, stay in your home, and then let the payments pay you out of your equity cover your at-home care. Okay. So that is if you're remotely considering doing any type of self-insurance or self-pay for long-term care. You've got to make sure that your primary residence is completely paid for. It's really so important if that's the route you want to take. Yeah. So, and we actually had an example of a client. She was, I think at the time, 94 years old. Sweet lady. Her and her daughter are clients of mine. Her daughter called me one day. Hey, David, my mom's doing great, but she can't live on her own anymore. She's 94. We don't have a long-term care policy. So she's like, what should we do? And I was like, well, what's the value of her home? Well, the value of her home was about $450,000 at the time. So I said, okay, here's what we do. We sell the home. I was like, first, go to 3 or 4 different long-term care facilities that are close by, interview them, see one that you like, come back and let me know what the cost is. She came back, let me know what the cost. She said, David, found a great nursing home. She's like, it's about 4 minutes from my house, so I can go and visit her. And the cost of care is about $4,500 per month. I said, great. I said, here's what we'll do. We're going to put her house up for sale. She has $450,000 in equity in her home. We sell the home. She still has Social Security coming in, about $2,300 a month for Social Security. So she's short $2,200 a month roughly to cover her long-term care. Well, if we just do some simple math, right? She sells her home. That's worth $450,000. $2,200 a month times 12. That's $26,000 a year is what she will need to cover her long-term care payment for her nursing home facility. If I divide that by $450,000,
it's about a 6%, right?
Yeah, that's 17 years worth of covering her nursing home payments.
Exactly right.
So this is an example of someone, she didn't have a long-term care policy, but she had her house paid for. And that house, which is almost $500,000, that's enough to cover her long-term care insurance. Because sometimes I think we forget we talked about it earlier, but the Social Security component, that's still going to be there while you're alive to help cover for your care. And then we've got to supplement that with something else. So that's an example of really, if you're thinking about self-care or self-insuring your long-term care expenses, got to have that primary residence paid for.
It's good. Some of these options are a little bit more on the creative side, but the encouraging thing is, even with the rising cost of healthcare, long-term care costs, people have options available to them, right, in order to cover these costs. So, in order even to protect their estate or just to maintain that care over time.
Yeah. As a planner, is there an argument that more people need long-term care, some type of long-term care insurance than probably have it?
Yeah, the thought around planning for the future is all about risk, right? Investment risk, interest rate risk, right? Tax risk for me as a tax planner, right? But with insurance, with long-term care costs, the issue is around risk, right? Are our projections of how high healthcare costs may be, are those accurate, right? Are they under what they actually might be 20 years from now, right? And so if they're accurate, well, great. Is my estate prepared to handle that type of cost, right? And I think that's really a big question. A lot of investors, a lot of people nearing that retirement age need to ask themselves, right? And if they ask themselves and the answer to that question is no, well then great. Hey, how do we go about either providing a policy or walking them through their self-insurance, right, to be able to cover those costs?
Yeah, because if you think about it, insurance is a big part of our lives. We insure our homes against disaster, flood, storm. We insure our lives with life insurance. You might insure a business if you have a business against risk or lawsuits. And the wager is always, well, yeah, I'd much rather pay a small premium today to help cover me for the unknown of what could happen in the future. But I think we forget about that healthcare unknown in the future. And the problem is we just don't know what life's going to bring us. We don't know what our health is going to be. We don't know what the situation will be as far as longevity goes. And so if you think about it, if someone has $1 million in an IRA today, and you have to fund a hybrid policy at $10,000 a year for 10 years, it's about 1% of your portfolio balance each year would go to premium payments for the next 10 years. And if you think about that, well, if you're earning 4 to 6% as a retiree on average, it doesn't seem like a large cost relative to your earnings power, your IRA balance. But I think it's just knowing what your options are. Most people just don't realize, hey, what is out there? I'm always shocked how most people know about the traditional policies. They don't know about the hybrid as much, or they haven't thought through the way to self-pay for it through their residence or through the equity in their home as well. Yeah. So I want to talk about the taxes really quick before we finish up. So if we have healthcare expenses, I know in some cases those healthcare expenses are deductible. Does that cover long-term care expenses for us down the road? I just want us to think through what are some of the tax issues around planning for healthcare expenses, in the future? Yeah,
they can be. So any type of healthcare costs that aren't covered by insurance, right? If you're getting them reimbursed by the insurance company, we can't deduct those, right? But if you do have healthcare costs, whether those are just normal medical costs or long-term care costs, well then great, those fall under the itemized deductions category. All right, so I know, especially for our retired, anybody in that retirement age over 65, the standard deduction is pretty high. I think for a married couple this year, it's going to be $30,700 that the government's just going to take right off your income. Okay, but what the IRS has said is if your healthcare costs, whether that's medical or long-term care, if those exceed 7.5% of your adjusted gross income. All right. So after all of your what we call above the line deductions, okay, well, great. Then we can start deducting those medical expenses if we itemize our deductions. Okay. All right. So if you have some other examples of itemized deductions would be mortgage interest, state taxes if you're still paying state taxes. I know a lot of Georgia residents don't pay that much in state taxes in retirement, but if you are, you can deduct those up to $10,000. Medical costs, but also charitable contributions. All of those would funnel under that itemized deductions category. So if those were to exceed $30,700, well, great. Now we get to itemize our deductions and take more income off of our taxes.
Well, but if say you don't have a long-term care policy and you're self-insured and you're paying $5,000 a month for long-term care, that's $60,000 a year.
That's going to be
that would be a straight
that's going to be
deduction.
deductible.
Yeah, it's going to be straight. Or
Yep.
if it's $100,000 a year,
Right.
straight deduction against income.
Exactly.
So that's interesting.
Exactly. Yeah.
Okay.
So let's say a great example. Let's say your adjusted gross income was 100,000, right? Between Social Security, required distributions, if you're over 73 now, interest earned on accounts, right? 100,000. Right? Well, great. Medical expenses under 7,500 aren't deductible, right? But if you just said, hey, we spent 100,000 on long-term care this year, well then great, 92,500 can be used as an itemized deduction and take off that much from your income right there.
Got it. So it's just a straight deduction. That's
Yep.
good. That's
Yep.
good. Okay.
Yep.
So that's important to know. So there's some benefit if you are self-pay.
There is.
Unreimbursed medical expenses. So
Mm-hmm.
unreimbursed from a long-term care policy,
Yep.
insurance policy, you can deduct those given you hit those requirements based
Exactly.
on percentage AGI and as you itemize.
Exactly.
It's good.
Yep.
Last thing I want to cover. So let's just say that you do have a long-term care policy. This is so key to know. What are some of the features about your policy? And one of the biggest factors that most people don't realize is there is a period that you have to cover before long-term care insurance will kick in. So for some policies that could be 30 days, for some policies that could be 120 days. And this is where the insurance companies know that if it's really chronic care and you have a 120 day, there's a term that they call it, but 120 day period that you have to self-pay before the insurance company kicks in, that can be an area of unknown that most people don't realize when they're getting their policy. The second thing that you really got to know about it, and this is important, is what kind of policy is it? Is it an indemnity policy or is it just a reimbursement policy? And these are two and most policies are going to be one or the other. Either they're going to be indemnity or they're going to be reimbursement. And there really are key differences. So the way that the indemnity policies work is it'll pay a fixed daily benefit regardless of what your out-of-pocket expenses are. So we'll just use this as an example. Let's just say you want at-home care, and it just turns out that your daughter is a registered nurse. And you say, you know what? My daughter has said that she's going to come by the house and check on me every day, and it's only going to cost $30 a day. Well, what would your cost be for 30 days? It would be $900. Well, your insurance policy, the one that we looked at, it may pay out $8,000 per month. This is key. An indemnity policy, it pays you the amount that's contractually obligated in the benefit amount in the policy, regardless of what your expenses are. So in that example, if your long-term care expenses, your at-home care expenses were only $1,000 a month or $900 a month, your policy still pays you $8,000 a month. Or if you're in a nursing home facility and the cost of care is only $7,000 a month, an indemnity policy will pay you $8,000 a month, or whatever your benefit amount is in the policy. Reimbursement policies are different. In a reimbursement policy, you may have a benefit up to $9,000 a month, but the policy will only reimburse you exactly what your care is. So for example, where your daughter was an RN nurse and her cost is only $900 a month, the policy is only going to pay you $900 a month. You've got a benefit up to $9,000, but it's only going to reimburse you for the actual care that you had. And that's a pretty key distinction.
Because with the indemnity policies, it's as soon as you can't meet two of the five
Two of six.
ADL, two
Yeah.
of the six, excuse
Yeah.
me, two of the
Yeah.
six. The ADLs are activities of daily living.
That's right. That's right.
So as soon as, I think it's a 90-day period where you can prove you can't meet two of those six, then great, that indemnity policy will kick in and start paying out that benefit there.
Yeah, that's exactly right. And that's actually pretty much all long-term care policies are triggered when a physician signs off and says you can't meet two of those six ADLs, which are called activities of daily living. So I'll just give you, what are those ADLs? Bathing, dressing, eating, transferring, meaning the ability to walk or move back and forth, toileting, and continence. Those are the six activities of daily living. If you can't meet two of those, your long-term care policy kicks in. And let's just say that you can't get dressed on your own. I know this is hard to even to talk about, but family members are dealing with. Let's just say you can't get dressed on your own, or you can't feed yourself on your own. You've now met 2 out of the 6 ADLs. A doctor would sign off on that, and then now your long-term care policy would then kick in. So that's really, I'm glad you brought that up, because I get that question a lot. Well, David, what is ADLs? What is the definition of it? How many do I have to meet, or a family member have to meet? 2 of those 6, your policy will kick in.
That's great.
Yeah,
that's great.
Well, look, we've covered a lot on long-term care insurance. This is a topic that I think it's important to at least talk through. What is your plan for long-term care? And do you have a plan in place? And if you don't have a plan in place, that may be fine, but what is the way that you're going to cover it? Mm-hmm. Whether is it through your primary residence? Is it through some other asset? It's a conversation that it's not a fun conversation to have, but it's an important conversation to find out, God forbid, we have a health emergency late in life. Are we going to be able to cover that care? So I think it's just something that as planners, we look at closely with our clients. But if you're someone that says, hey, David, I'm not sure, do I need long-term care, do I not? Obviously, feel free. I would encourage you to meet with your financial advisor. If you don't have one, our firm, we'd be honored to sit down with you to share with you what are your options for long-term care. Are one of these policies right for you? Or are you going to just be better off self-covering care as you get into retirement?
Absolutely.
So, awesome. Well, I appreciate you joining us this week for another week of the Retire Ready podcast. Hope you enjoyed it. You can check out our website at nicholaswealth.com, and we will hopefully be back here for episode 6.
There we go.
In a couple of weeks.
That's right.
I'm excited. Should be good. Awesome. Thank you, guys. We'll see you then.
Cool.